So let's continue with the equity financing option. So let's look at strategic tax planning, August 2020, question 4. Now, it says some scholars argue that from a strategic tax planning perspective, debt financing provides more tax benefits to companies than equity financing for tax investors or for investments. Required with appropriate authorities discuss the accuracy or otherwise of the above assertion. 20 marks. So, how do you deal with such questions in the strategic tax planning exam? First of all, remember that when it comes to the financing options, debt and equity and others, it is not the financing options themselves that have the tax exposure or the tax savings or whatever you may call it, or the tax consequences. It is the returns on those investments. So, first of all, you must first talk about the kind of finance. Let's say if you are talking about debt, you talk about debt, the definition of debt, what kind of debt or what debt is, and tell us that it is the return on the debt that we are looking for. So you go into the act, at least give us the definition of interest, that it is the return on the debt, which is the interest that is subject to tax or that brings the tax saving or whatever. Then you start giving us some incentives or some rules associated with interest and taxes and all that. Okay, so first of all, let's discuss equity. So you see, it says the returns a person receives from holding equity in a company is dividend. So see definition of dividend in section 133 of the Act. So even if you don't remember, just say see the definition of dividend as per at 896. So dividend is not deductible for tax purposes in the books of a company which pays dividends. So dividend paid is subject to withholding tax of 8%. You have to also say that. And a dividend paid to a resident company by another resident company is exempt from tax where the company which receives the dividend controls either directly or indirectly at least 25% of the voting power of the company paying the dividend. So this is a common provision which cuts across and you should very much know it. So, where a company which is controlled by not more than five persons and their associates does not also distribute its to its shareholders as dividend, a reasonable part of the income of the company, the Commissioner General may treat any part of the company's profit as dividend after considering the current business requirements of the company and any other requirement necessary for the maintenance and the development of the business. So, the Commissioner General shall treat any part of your profits as dividend under section 59(8). Usually, if you're a closed company, you are not more than five persons. This is sort of an anti-avoidance provision which stops uh, persons in controlled relation or companies which have very small members to actually distribute dividends because most of them treat their dividends as salaries, and that is what the Commissioner General does not want. Okay, so let's look at debt. So the return on a loan or debt obligation is interest. So you have to see the definition of interest under section 133. And also interest paid on debt obligations which is employed in the business or used to purchase an asset which is employed in the business is generally deductible for tax purposes. So we can see this under section 10. So with the exception of interest received by an individual from a resident financial institution or interest received by a person on bonds issued by the government of Ghana, interest on debt paid to an individual is subject to withholding tax at 1%. So you can also bring the various rules on interest in the answer. And interest on debt paid to a person other than an individual is also subject to tax at 8%. So, from the above information, it appears that the restriction placed on a company from deducting dividends before the computation of chargeable income appears to make debt financing a better tax planning option due to the fact that interest paid on debt is usually deductible for tax purposes. So, you are expected to discuss that debt financing by an investor may expose the investor to transfer pricing scrutiny and think capitalization restrictions on interest deductibility. You can go forward to also explain the terms of related party lending arrangement and that they must comply with the arm's length rules under Art 896, and the terms must be compatible with capitalization provisions where the person providing the loan is an exempt person and the entity receiving the loan in Ghana is a resident entity which is not a financial institution. So, in line with the arm's length standard, we looked at the anti-avoidance provisions, okay, under Section 31 and also Section 33 for capitalization rules. So if you're able to discuss this, I think you should be able to get your 20 marks full. Okay. And sometimes you can even chip in some numbers. Say if the investment was supposed to be 100,000, taking 100,000 with a return on investment of let's say 10%. So using that, you take the 100,000, assuming the whole 100,000 were used to work to generate the same amount of revenue. The profit before tax is the same 100,000. Take the 100,000, take interest, take dividend, you work it out with some numbers. So a similar one is something like this. You see. So see if you take this, let's say this 100,000. You see we have debt, we have equity. So income before payment of interest and dividend, you bring it here, you bring it here. So for interest, it gets deducted. Then withholding tax is applied on it, and also then after you take out the interest, you get your taxable income, then you tax it, then you take the tax out. So your profit after tax is what dividend will be applied on. So at the end of the day, dividend will also fetch withholding tax. But if you see, you realize that the total tax exposure for equity is higher than debt. So, from the scenario above, it is preferable for the investor to finance the activity of the company with debt instead of equity, given the total tax exposure on the investment. But don't be fooled. Most of the time, yes, debt offers a tax shield for exam purposes. That is what you need to say. But you can go for it to say that too much debt financing also reduces profits. And reducing profit means shareholders wouldn't be happy because when you can't pay dividends and you can't increase shareholders' wealth, which is the main or primary financial objective of every company or every business. So if you're able to say that, I think you should maximize your marks.